Okay, good morning, everybody. Welcome to the August episode of the monthly Altos Research webinar. The thing that we're paying attention to right now is, as we're looking in the data each week, it sure seems like there are some slight signs of cooling. We had last year, of course, ended so frozen solid. There was so few buyers. We saw inventory building because buyers stopped cold. And then after the first of the year, we were surprised. I was certainly surprised that we had more buyers and sellers. Inventory fell very late in the year, kept falling well past the normal time where inventory falls and starts building for the spring buying season. We had more buyers and sellers, and that was that I didn't expect it. I expected cooling economy. I expected the impact of higher mortgage rates, all of those things to continue into 2023. As we marched January and then suddenly February, we could see those projections were changing very rapidly. We could see more buyers and sellers, even at the current prices and the current mortgage rates. What I've noticed in the last really 2 months, mortgage rates had climbed back to over 7%. This week, they're higher than 7%. And obviously, home buyers and sellers, they are sensitive to the affordability of higher mortgage rates. And so the surprising strength of earlier in the year seems to be maybe gone from the market now. We don't see it's not as nearly as abrupt as last year. These are very subtle slowdown signals, but there are some implications, and there are some things in the data that we're going to look at today to keep our eyes out. Is the market going to slow further from here? How quickly do consumers adjust to 7.25% rates? What happens if rates go to 8%? Those are the things that we'll talk about today. So I'm Mike Simonsen. I'm the founder president of Altos Research. And what we do at Altos is every week we track every home for sale in the country, all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. We do our videos every week, and we do these webinars where we go for an hour long once a month. So we're going to spend a lot of time and dive in today. As always, the webinar is recorded. So if you've registered and you're here, you will get an email from us later in the day when that recording is available on the YouTube channel. You can always check that out. You can share it with others. Use the chat box right now. Let us know where you're coming in from. Love to see everybody from around the country and around the world even. And Paul dialing in from Mars. Use the chat though. We'll have Jeff Graves and Lael Black from the Altos team are in the chat. As I'm talking, sometimes if you have questions, I can't really stop and pause and answer the questions, but Jeff and Lael will try to answer things on the fly for you, especially if I share a link. You can click through on those links and go download or hit the reference that I'm talking about at any given time. So use the chat box for that during the conversation. Then what we'll do is we're going to start by doing an overview of the national data. And really, I'm going to look in to see, are there signs that maybe we're cooling off? And we are hoping for this an even stronger finish to the second half of the year. But we're going to take a look and see what we can see right now in the data. The latest on inventory is, are we ever going to get any inventory? What does that look like? Home price trends. We spend the last part of the webinar doing local data. And if I don't get to your local market, obviously I can't get to all the local markets. What we ask is that we can do your local market. Go to altosresearch.com. You can book a free consult with our team and dive into your local market and how you talk about your local market with buyers and sellers right now. So a lot of what I do when we're doing the data here is I will try to to point out these are the things that home buyers and sellers need to know right now about the data and how you can communicate with them. And we can do that with you at your local markets as well. So if I don't cover your local market, go to altosresearch.com and book a free consult with our team. Before I dive into the data, let's, if you need to understand about how to communicate with the data, how to use market data in your business, use our free ebook. It's free. It has scripts and ideas, strategies about when to talk about the data. It references the data that I talk about in these webinars that you get in your Altos reports, and you can get from other sources too, and how you talk about that data. So go to get that free ebook. There'll be a link in the chat that you can click through and go download that. That'll help you communicate with the data. And then, of course, we'll do these, keep coming back to our webinars here, so we talk about the data all the time. All right, let's dive in. Let's start with inventory today. There are 492,000 single-family homes available on the market. It's climbing by less than 1% each week, but it's still climbing. It's not uncommon for inventory to peak at the end of August, so that'd be 2 more weeks. And before it starts the September, the second half of the year, decline in inventory. By the fall, usually, there's fewer new listings, and the buyers are cleaning up the last bit. And so you can see each line on the chart here is a year, and we start low typically, and then inventory builds, peaks at August, end of August, and then down again for the holidays. This year, inventory peak, the bottom of inventory we didn't get the lowest point of inventory until April, because we had more buyers than sellers in the first half of the year. It was super surprising. We are now 10% fewer homes on the market than we had last year at this time. And if you look at this chart, the dark red line is this year. The light red line is the curve from last year. Started ultra low, the end of the pandemic buying frenzy, rates spiked, inventory climbed during the year. And then in September, there's a little inflection point. That's when rates jumped from like 6.5 to 7.5 in a few weeks. And that's when the market stopped really cold. And that change in rates also then it created late year inventory build last year. So inventory didn't peak last year till the end of October. So what we are looking at now is 10% fewer homes on the market than last year. It's about 50% fewer homes than 2019. So still in this pandemic, like there's a new normal of where inventory will be for the following years, with multiple years before inventory climbs. If mortgage rates jump from here, like they did in September last year, if for whatever reason the economy data reports really hot, or inflation data reports really hot, that would imply that rates are going to stay higher for longer, and that could push mortgage rates higher. So what if rates go from 7.25 to 7.5 to closer to 8? If that happens, expect inventory to grow, buyers to slow down, like what happened at the end of last year as well. So if rates stay in the same bound area, around 7, then we'll have a normal seasonal curve coming up. We'll finish the year with 10% fewer than last year. It could be as many as 20% fewer, and I'll show you the forecast of inventory in just a second. I want to take a moment to point out that the question that's on everybody's mind, we've been getting it every day, is when do we get more inventory? And the conventional wisdom, your buyers and sellers may have this, you may still be in this mode. So take a moment to think with me here. The conventional wisdom is that once mortgage rates come back down, that will give us more inventory. But the data shows that the opposite is true. And we're calling this the Altos rule, because I'm trying to make sure people really follow the data here. The data shows us that it's higher rates that yield greater inventory. Lower rates create lower inventory. And the reason is holding costs. When rates are higher, the cost to hold real estate is higher, and therefore I am more likely to sell it or resell it. When rates are lower, it's more affordable to hold my real estate. Therefore, I am more likely to hold it or hoard it. So during the last 10 years, and what we have here on this busy chart is the gray line is that same inventory data that I just showed you, but it's like in one long multi-year line. So the gray line is what you can see is inventory has been falling every year, essentially for a decade. The exception here was 2018 to 2019. And you can see the colored line is mortgage rates, and each color is a year. And so in 2018, rates rose all year. And between 2018 and 2019, inventory rose. Then in 2020, rates fell dramatically and inventory fell dramatically. Then last year, rates rose dramatically and inventory rose dramatically. We then, most of this year, mortgage rates were now we're at the far right end of the chart. They've been in this sort of flat range since last year at this time. They've been in this bound range of between 6 and 7 and a little over 7%. And so rates, most of the year were down a little bit. You could see they were from that 7.5 peak down to into the 6s. And when that happened, inventory was falling because we spurred demand. And so we had more buyers than sellers this spring. Now, in the last couple of months, this is the bright red line at the far right end of the chart there. Interest rates have been stubbornly around 7% and inching higher in the last few weeks. And so what that implies is probably late year inventory build. So we've got at least a few more weeks of mortgage rate of interest inventory building. If rates stay above 7.25, like you could see it continue to build in September, later than that. If rates, on the other hand, start falling again, back down, then inventory will fall. So the Altos rule is what gets higher inventory? Higher mortgage rates. What gets lower inventory? Lower mortgage rates. And so if rates fall from here, expect that to spur demand. That means more buyers. That means taking inventory out of the market. That means it's cheaper to hold. That means I don't have to resell. And so therefore inventory falls. And that's what we've had for the last decade. And we're right now we're looking forward. You can imagine if in going the next several years out in the future, if rates stay high or inch higher, it could take us multiple years to get back to that normal level of inventory. Normal this time of year, of the last decade might have been 1 million or 1.2 million single family homes on the market. And there's 490,000 right now. So it could take multiple years of higher with resetting the cost basis of, 5 million homes a year, transactions a year. You have those then when they go to buy the next one, they have to resell. So that's the Altos rule. And when somebody asks you, when do we get more inventory? Really do rates have to fall back down before we can get more inventory? And the insightful answer is that the data shows the opposite is true. Higher rates will get us more inventory. Now, we also talked about, potential recession. We've been talking about potential recession for 1.5 years. It's not here yet. The economy has been remarkably strong, and which is one reason that mortgage rates are still high, is because the economy has been unexpectedly strong. So, once recession gets here, inventory of distressed sellers, people who've lost their jobs, is really another year out in the future. It is, I lose my job, and then now it's 90 days, and wow, I haven't got another job. And then now I start worrying about my mortgage and stop paying my mortgage. And now it's 90 days before I start working with the bank. So what happens is, like, there's 6 months before anything really even starts. And so it is a good year before we see inventory from a recession. Recession's not here yet. Like we're still at maximum full employment. So if let's say recession starts at the end of the year, then we're really looking at 2025 before we see any inventory from that change. And that assumes that we have a big job loss recession out there. At Altos, we don't predict recessions, and we don't predict interest rates. So, I like to say I've been wrong on interest rates for 30 years. So I don't know whether rates go up from here or down from here or go sideways. But what I do know is that if rates go down from here, that spurs demand, and that's when inventory will decline in the future. All right, so that's the Altos rule on inventory. So therefore, the projection of inventory through the end of the year looks like this. So this is the same inventory chart. Each line is a year. The dotted line here is the forecast of inventory week by week through the end of the year. Right now, it looks like we will have our seasonal peak sometime in August or September, early September, and then inventory will start declining down for the fall, as it does. And then we will end the year with just over 400,000 single-family homes on the market. That would be about 15 to 20% fewer than last year. So, last year we ended with about 500, and now we're closer to 400,000. If rates keep inching up like they have the last few weeks, this number will get revised up. That'll keep revising up because each week there will be slightly fewer offers, slightly bigger inventory build, slightly later to fall down. So to curve back down on total inventory count for the year. So what we're looking at here is just over 400,000 at the end of the year. It is still in this, pandemic normal space. And if next year rates inch down, then you can imagine that inventory will be lower to end 2024. That's what the forecast looks like right now. When I started the year, this forecast was assuming we'd end with closer to 700,000 homes on the market at the end of the year. We assumed that inventory would be building like it did in the fall, and that economy would be slowing, and all of these factors would allow for greater inventory growth. But the thing to note now, and this is important when you're talking with especially buyers and sellers who are on the fence, especially buyers who are waiting for, like, I'm waiting for the big flood, I'm waiting for those bargains to show up. There is no sign anywhere in the data of any surge in inventory. So where would inventory come from? It might come from those distressed homeowners, but nobody's distressed yet. It might come from investors or Airbnb owners who are like, there's an Airbnb bust and there's no renters. And so suddenly my cash flow property doesn't cash flow and I have to sell it again. Those things could happen. Those are the bearish scenarios a lot of people talk about, but there's no sign anywhere in the data of any of that happening yet, like anywhere in the data. So we can see that investors, especially big money investors, stopped buying. The demand fell off, but are essentially not selling. And we can also see from this year in places like Phoenix, we had a little bit of price correction at the end of last year, and that there is capital on the sidelines, big money dedicated to, for example, single family home investment purchases. And as soon as we saw some price correction, the money stepped in and put a floor on prices. And so that was really notable. Before this year, I didn't know, is the big money going to stop and exacerbate a downturn, or start selling and exacerbate it, or were they going to jump in and buy? And what they did, at least this year, was they helped create a floor. So that shows us that there is no sign anywhere in the data of any surge in inventory. So if you've got a buyer who's like, I'm waiting for the big crash to come, the question is, how long are you going to wait? Because it could come. There could be some. Maybe it's next year. Maybe it's 2025. But there's no sign in the data right now of any of that coming. So I've got a couple slides on the new listings pace. during the pandemic, we the defining characteristic was what I call immediate sales. These were put the homes on the market. They go on Wednesday, we're taking offers on Thursday, we're in contract before the weekend. And the house spends essentially zero time in inventory. Those immediate sales were as much as a third of the market when we were in these peak times. So what we've got here is each bar in this chart are the new listings each week, with the light portion of the bar, those that are going into contract essentially immediately after sale, hours, days, a couple days before, not even spending a week on the market. Like a third of new listings were doing that during the pandemic. It's significantly fewer now. And so the light portion of the bar is each of those new listings each week. And what you can see is we have, 74,000 new listings this week, with 14,000 of those into contract immediately. And that is significantly fewer than last year at this time. You could see that in the middle of the chart here, the bump listing volume dropped after July 4th last year and never recovered. It just went straight down all year. And you could see what you can use the immediate sales for, the size of the light portion each week there, the light portion of the bar, that's your demand indicator. And you can see how at the end of last year, those immediate sales shrunk very dramatically. There were fewer and fewer of those immediate offers. And so that's like a measure of, it's a proxy for how many people are out there in the market competing. That grew, immediate sales grew this year. And so each week, as the number of immediate sales was growing, the bar is growing higher. That's us, we're looking at April, and there were still people in April who were thinking this market's tanking. They were still looking at fourth quarter data, and they were still, the headlines were still saying year over year home prices are declining. But what we could see is that there was demand out there, and they were buying the homes, and that was keeping a floor on pricing, that was keeping inventory low. We could see all of that in the data well before the headlines saw it. And what it shows us right now, though, immediate sales are shrinking. People are responding to mortgage rates at 7.25%. And if I've been shopping and assuming it's 6.5%, and now in a few weeks it's grown to 7.25%, I don't make that offer. And so now it sits online. I don't go into bidding wars. I don't do multiple offers. I don't make an offer as soon as it lists. I wait to see if there's other people buying, or maybe I can get it at a discount. Like, all of those factors are starting to happen. And so this is one of the signals that consumers looks like they're slowing down subtly for the second half of the year. Like, the surprising strength of the first half of the year seems to be gone from the data as of right now. And then we can look at those unsold new listings per week, each week here. And this is, each line here is a year. And you can see the dark red line is how many fewer new listings we have than in normal years. So our sales rate this year is very low, 4.2 million. Maybe it's going to go lower to closer to 4 million. And this is two things going on here. Demand's obviously down, when rates are up, but this is a supply constrained market. If there was more sellers, we would have more buyers at these prices, at these mortgage rates. Or at least that was very true for the beginning part of the year. Demand is now slowing again. But what we can see here is that you can't use the sales rate by itself. The NAR's 4.2 million number is restricted from supply. So we have to use other indications of demand. That's why we use things like immediate sales to really know how much demand there is out there. We could see last year, a couple of things on the line, the light red line here, last year's curve. That's when sellers stopped selling. We could see the spike the interest rates in September. And after that, new listings rate kept falling to really record lows each week. For a while earlier this year, I thought we might get some sellers, but then they just never materialized. So this is a supply constrained market. And so again, for people who are waiting for the big surge, I'm going to wait for this bubble to pop. I'm going to wait till there's a bargain out there. we have to get back to normal levels of sellers before we get to a surge in sellers. So there's really, it's a long way out. And some of these things can change quickly, but really there's no sign anywhere in the data of things like a surge of new inventory. It shows up in days on market. So you can see the annual curve here. Each year goes down, and the peak, the trough is, the peak buying season. Last year and the year before, the market time, so many immediate sales every, we're 20 days on average for homes. But starting, mid last year, market time was climbing rapidly each week, and as the year went on, and that was because buyers stopped cold. This year, market time is longer, right? Demand is less than it was during the craziness of the pandemic, but it's not climbing yet. So we're still in a pretty balanced market, right? And so, but very soon we'll start hitting the fall, and then stuff sits on the market longer in the fall. And so days on market will start climbing in the fall, but it's an indication here of, how balanced the market, how surprisingly balanced the market was this year. And that this is not an abrupt change in demand, but people are sensitive to the affordability. All right, let's switch to pending. So these are, when we look at what we're doing is watching every home that's going into contract each week and the total number of homes that are in contract each week. This is the earliest proxy for the sales rate. Homes on the market now, it gets an offer in September and goes into contract. That doesn't close maybe until October or November. But we can see right now the ones that are going into contract, what their price is and how many are going into contract. And so the sales in the future are going into contract right now. So as of right now, there are 364,000 single family homes in contract. That is 10% fewer than last year. So each bar here is the total number of homes in contract in a given week. The light portion of the bar are the newly contracted that week. So these are, we listed, we took offers, we're in contract, we're pending. And that might take 30 or 45 days till you get to close. And so they sit in the pending stage. So there were, last year at this time, right in the middle of the chart here, you can see the pending sales was dropping pretty rapidly, especially after the 4th of July, offers stopped. If you were buying last year and selling last year, there was a lot of pull forward to get that done in the first half of the year. But then by July, people are like, wow, rates are spiking, demand's off. I'm not even going to sell. So you could see that dropping dramatically. And then again in September and October, when rates spiked again. One of the observations there on rates is that it's maybe not the absolute level of rates, but it's the rapid change. It's the change in rates that consumers are most sensitive to. So, rates have been at the same 7% level for a while, but in that September period last year, they jumped. They went from close to 6 to 6.5 to 7 to 7.5 really rapidly. And you could see the impact on the market, right? So it's the change in rates that people are most sensitive to. People are shopping at 7%. Now they're planning affordability at 7%, and their life events mean that there's still time to buy a house now, and they're just going to buy at 7%. But if they're looking, all of a sudden it's 8. Now they restrict. But so in the last month, we have seen rates inching up, and we can see slightly fewer offers being made. We could see that. So this week there are 62,000 new contracts in the single family homes space. That number, that the light red portion, has been inching closer to the volume of last year. And for a while, I thought we were going to have more, maybe exceed sales rate of the second part of last year. But that's actually declined again. So we're kind of not on pace to improve the total sales volume. And so it's 11% fewer than last year. And so meaning we're not gaining any ground on the total number of homes in contract. And so that's another one of the signals that says, consumers are sensitive to this latest, jump in rates from 7 or 6.8 to 7.2. It makes a difference, and we can see it in the sales rate. That means if you have sellers listing on the market now, there's early signal that people are paying attention to that. And do you want to get ahead of that decline? Do you want to do a price reduction sooner? Your new listings, do you maybe want to list at a discount now to make sure that you're not on the market too long and letting these trends take over? Okay, let's talk about pricing. The median price of single family homes in the US around the country right now is $450,000. That is actually unchanged from last year. It had been down a little bit. Prices had been down year over year, but what's happening is normally prices peak in June, and with the buying and frenzy, buying and selling, that's peak demand time, and then they decline for the second half of the year. Last year at this time, prices were declining pretty rapidly each week. This year, we're on a nice little plateau. So each week, we'll have a little bit better, easier home price appreciation comparisons. We'll end the year with about 3% home price gains over 2022, which is totally a surprise to me. I know I had the beginning of the year, I would not have expected an up year for home prices, but really that's what it looks like we're going to be. Unless we see a sharp spike in mortgage rates, and then we can see, like we had last year, you can see last year the really abrupt, every week home prices dropped in this dark red line after those mortgage rates jumped in September, ratchet, each week down. And so it was seasonal, but it was accelerated seasonal this year. So if we have something like that and all of a sudden rates are at 8%, the market's going to respond exactly the same way. Buyers are going to stop very quickly. Prices will have to adjust down, and you'll see it. And then we will probably eat up that what looks now to be a yearly annual home price gain. The light red line here is the price of the new listings each week. And I love this one as a leading indicator for where sales prices will be in the future. The median price of the newly listed cohort this week is $399,000. And you can see in the light red line, that one usually peaks in May and then starts declining because the best inventory is getting listed in March, April, May, and then by July, June, July, August, you start doing a little discount because now it's getting late in the summer. And so what we could see last year was a really sharp spike at the beginning of the year, people still buying aggressively, and then an abrupt downturn. This year is a much slower drop in the new listings. And that's because sellers and listing agents, they know exactly in aggregate, exactly where to price the house. Any given house might be over or underpriced, but in aggregate, they get priced very well. We know how many people were at the open house down the street, and we know if there were overbidders, and we know which ones got a price, like a premium. All of those things we can see as sellers and as listing agents. And so what this shows us right now, this $399 shows us a nice little plateau where, basically the same as we were last year at this time. But last year was falling rapidly. So that is another signal of price plateau, price stability for this year. And again, unless you get another rate spike, and then you'd see that, you'd see it in here as well. The price of the new listings. House gets listed today. Now it's on the market for a few weeks. It's the part of the whole market set. Then it gets an offer, and it goes into contract, and then it's sold. So you can see a 4-month leading indicator of where sales prices will be. And then let's talk about those sales prices. So these are the homes that are going into contract. There's 2 lines in this chart over a couple of years here. All the pendings, all the homes in contract is the light red line. And then the jumpier, the dark red line is the price of the homes that went into contract in a given week. And what you can see is during last year, during the rate spike times of last year, buyers said nope, and they did a discount. I gotta shift down. I'm gonna downshift. I'm gonna make a lower offer. And so you can see in June and September of last year, boom, you can see the sales prices drop down dramatically. Then this spring, you can see the dark red line climbed. It climbed above the light red line, meaning there was strength in those buyers, the new contracts each week, strength in the buyers. But what we see right now at the far right end of the chart is each week, the new contracts, they're pricing slightly lower. So now we're at 371,483 this week as the median price of all the homes, that single family homes that went into contract this week. And see how it's starting to ease lower? That's another one of those, the third signal, as I mentioned, of perhaps softening in the market. That surprising strength of the first half of the year really seems to be like, maybe we're losing it there. And because rates went from 6.8 to 7.25. And it's really going to be sensitive. So keep your eyes on this data, especially if we see what happens to rates in the next 6 weeks. It'll be really fascinating to see, do consumers hang in there, or are they getting priced out? And then we'll watch it drop in the pending sales price. The last one of the slides, then we're going to switch to local market data. On pricing side, I like to look at leading indicators. So we talked about the price of the new listings as a leading indicator. We also use the percentage of homes on the market with price reductions as a leading indicator. So a home is on the market now and doesn't get an offer. So in September, it takes a price cut, and then it gets an offer in October, and then it closes in November, and then you start hearing about it in December. But we can see right now the ones that are taking price cuts. And so the normal rule of thumb for the country is that about a third of homes take a price cut before they sell. Sometimes that's intentional, strategic. Sometimes it's, a wacky seller, whatever the reason is, but about a third take a price cut. Some markets, it's more like closer to 40, like Phoenix is a market where it tends to be closer to 40% is normal rule of thumb. And you can see each line here is a year, and the dark red line, price cuts rapidly normalized in the first part of this year. Went from really cold, 40% down into the normal range. What we're noticing now in that dark red line is that slope is starting to tick up a little faster than normal, just a little bit. And that's because at 7.2% rates, slightly fewer people make an offer, slightly more sellers need to do a price cut because their house didn't sell or didn't get an offer yet. And so we see that accelerating just a little bit. I thought for a while that we might end, in the under 30 range. You can see the curve from 2018 and 2019. We might end it with fewer price reductions, but right now it looks like we could end up above those. So this really indicates that another one of those signals for slight cooling in the market. And it's not a lot. It's mostly balanced. Many markets are still getting their multiple offers, but some markets are slowing down more than others. And I'll show you a couple. And so it really impacts, when we're talking to buyers and sellers right now are, look, there's a shortage of inventory. There's not a lot of sign that you're going to have a lot of competition of inventory, but buyers are sensitive to mortgage rates. So we want to list this now, but we want to price it correctly because we want to be in front of this curve, not behind this curve. It's a late season listing if you're listing now anyway, but it's the percent of price reductions is a useful tool when you're having that listing conversation about making sure we price appropriately so this house moves. All right. Let's switch and look at some local data. In fact, let's start by looking at the markets and ranking price reductions so we can see how they compare. This is the Altos research system on the back end. I've taken the data out for the slideshow in here, but Altos users, everybody has their reports that they subscribe to. These are customized for you, branded for you. This is my Altos report for Mike. It's my national one. I can see I've got reports all over the country. I can see who's reading and how many people are reading. I have my new leads in my database, and these are the people that are getting their reports every week in my contacts database. I have 107 new leads this week. I have, I can see my email campaigns that are going out to my contacts across the top here. And then the advanced analytics page here, this is where as a user of Altos, you can go build charts with the data like I've just built. And like what I've been showing. So when you want to communicate to your buyers and sellers, like I built a chart here that is Dallas. What I wanted to do was show Dallas area. Inventory was climbing, but how low is it compared to last year or compared to pre-pandemic? So I've got, you can see I got 2017, I got 2018, 2019. I took out the pandemic years, and here's 2023. I've got the inventory chart that we shared in the topic, in the talk. I've got my pending home sales. So I have this big comparisons, big dashboard that I use, and I do it for customers. I'm going to let that guy load up, and we'll dive into price reductions. We have what I've done is, one of my queries that I like to have set up is I like to rank the 50 metros, big metros, that have the most price reductions right now. And what that tells us are the ones that are slowing, the markets that are slowing fastest right now. Last fall, you could see, you can use this spark line here to compare how quickly they're changing. And so you can compare Austin and San Antonio to Tampa. What we could see last fall was we went from normal, rule of thumb, normal levels of price reductions is 30 or 35%. And so Austin had 10%. And that was because even the sellers who thought they were overpricing were getting their prices. We were getting multiple offers. So nobody had to do price cuts. Things were going as quickly as possible. But then very quickly, price reductions, the demand stopped. Price reductions went from 10% last year up into the 60s. 60% of the homes on the market had taken a price cut, when a few months earlier, it was only 10%. We saw a little bit of recovery this year, back into the 40s, and now Austin's kind of ticking back up again. So we'll look at Austin, the Austin Metro, in just a second, because you can really see Austin was one of the hottest pandemic markets, and it's one that cooled the quickest. In fact, the Western US markets, Denver's right here too, Colorado Springs, you can see Salt Lake. These markets were super hot, 10% price reductions to 50 or 60%. They cooled very quickly. The Western US ones were much more sensitive to boom and bust than the rest of the country. So right now, if you've been watching these webinars the last few months, you'll notice that the Florida markets had been dominating the price reductions earlier in the year. And now it's back to Texas. We've got Texas, Colorado. You can see the Western markets climbing again. And then we get back down in here, and now you can see some of these that are, still in more normal range of price reductions, and haven't really dived into price reduction. So I like that build. I build that query. You could build a query like this for all the zip codes you cover. All right, let's dive into some of the reports. So this is an Altos report for Austin, the Austin Metro. And remember, Altos does this for every zip code in the country. And I'm showing you mostly at the Metro level to dive into our local views here for the next few minutes. The market action index for Austin. So this is supply versus demand. And we can see really balanced market, and maybe even tipping into buyer's territory very soon. We can see here in the real-time profile section, these are this is what's happening right now. If you walk into the Austin market right now, into Austin Metro, the median price of homes is $575,000. That's what you can buy right now. It is easing down. We can see time on market is climbing a little bit. We can see price decreases. This is the last 3 months. These prices, homes are cutting prices, and that's because they're noticing less demand. And so then we can look at, for example, median price of homes in Austin over the last 5 years. We had the big pandemic run-up. We had the last spike, and then last year price correction back down. And we are not back above where we were during the pandemic in Austin. We're right about the same place we were at the early part of that pandemic. So like we are down, home prices are down still a little bit in Austin. It's one of the few places around the country where home prices didn't really recover this year past that peak. But it was really this super strong peak that Austin had at the beginning of 2022. We can look down in the price range quartiles down here, the market segments. Every Altos report has 4 price range segments. The high end of the market may be behaving differently from the low end. So when you're sitting with your client, you say, yes, I know that you see that the house down the street's been on the market for 2.5 months, but in the price that you're buying, we actually have some competition. So if we want this house, we need to make an offer. And so we use that for framing the discussion with your buyers and sellers in their price range inside. And this is in Austin Metro, but in the zip code works the same way. So right in the zip code, the high end of the zip code may be behaving very differently from the low end. I was in Raleigh, Durham a week ago, and so I was looking at data in Raleigh. So I have the Durham metro market open. We have the thing I noticed in Durham is that you could see inventory climbed last year. So this is the inventory chart here rather than price. I have inventory, and in Durham normally maybe 1,400 homes on the market, and we're still at 600. Inventory is not yet climbing, not really climbing for the year. This is amazing. Didn't climb at all this year, really still at the year's lows for inventory for that metro. It really shows a lot of like inbound migration, a lot of the economic growth things that happened that it kept floor on pricing and things in Durham for the year. You can also see exactly where the demand is in this metro market. Things under $1 million are moving quickly. Over $1 million is a much different proposition, but it's also bigger land, newer homes. It's bigger properties. Like you can show exactly what you're getting for your dollars in the Durham metro market. Let's look. I was talking with a client in Bergen County, New Jersey this week, and here's one thing that was really notable for this year was, while I mentioned the South and the West, primarily the Western US markets, were the real boom markets, the pandemic boom markets. The places they were moving from, you move from New Jersey to Florida or Atlanta, you move from Chicago to Arizona. The places that we were moving from have not recovered inventory. We are in Bergen County, New Jersey. We're at pandemic lows. We're record few homes, 700 homes compared with 3,000 or 4,000 normally. And so in terms of thinking about what buyers and sellers need to know, is there a surge of inventory coming? Is there a crash coming? This is where we say there's no signal anywhere in the data of any surge of inventory. When we look at the price range segments in Bergen County, you've got high end stuff at 2-3 million. Those are taking much longer. And look at this, at the $500,000 stuff is still moving in 14 days because there's nothing available. So you can really see where the demand is and how this changing market is showing up in a place like New Jersey or a lot of the Central and Northeast. I had a client conversation with someone in Fort Collins this week. So one of the Western markets. Fort Collins is, you can see home prices have been holding steady this year. We have days on market is starting to climb a little bit. Our price reductions were pretty low and are starting to get above normal. So we can see some of the slowing signals in the Fort Collins area, for example. This is that percent. I've got this set to percentage of homes with price reductions over 5 years. And what we can see is in Fort Collins, this 30% range, 25, 35, you can see is a normal range. During the pandemic, 7% of the homes needed price cuts. 30% think they're overpriced, but only 7% needed to take. And then last year, here's where the demand really starts cooling. And we ended last year with 47% of homes with price cuts. And so what we know now is price cuts are starting to tick back up. And this is, again, one of those areas where, affordability is notable. And so, if I'm shopping at 7% rates and suddenly they're 7.25, I don't make that one deal doesn't pencil out anymore. I don't make that offer. That guy ends up cutting his price. And so you can see it show up in the data very quickly. And, we can see in that Fort Collins area, the stuff over $1 million, a little more time. Things are still moving pretty quickly under $500,000. So it is like you can see that mix there. Let me just finish up. Let me do Seattle. I have Seattle open. I was interested in, Seattle has sort of been one of these markets where aren't prices declining in the single family homes. What I did here for Seattle is I looked at single family homes and the price per square foot. And what's interesting is, price per square foot is still held up pretty well in single family homes here over the last few years. But if you look at condos, we can see condos price per square foot has no price appreciation basically for 4 years here. You can really see how this is where, when you have migration patterns change, that's really what you can see. It's like condo owners that are living in the city, and that's where you can see that trend, very different from single family homes. Okay, if I didn't get the chance to look at your local market, go to altosresearch.com and book a free consult with our team. We can spend time with your local market. We can talk about your local market. And as I mentioned at the beginning, all of the data I talk about is described in the free Altos ebook. So there's a link in the chat. Lael and Jeff will drop that link in the chat for you. The free ebook, you can talk, there's scripts, how to talk about the data, how to understand what questions are consumers going to ask. So that's a really great free resource. You can go click there and download that right now. As always, we're here to help you communicate to buyers and sellers right now. And if you're sitting there going what am I telling people about this market? What do they need to know? Why do people keep telling me there's a surge of inventory coming? Go to altosresearch.com, book a free consult with our team. You can sign up today and you can get the data. We can have it in the hands of your clients, your buyers and sellers, immediately, this afternoon. So if you've got folks that you need to nurture that are still they have questions, they're making their delays, get them the data. They need to understand what's happening and they need it coming from you as their realtor. All right, everybody, that's all the time we got for today. I'll stick around. We'll make sure everything's done in the chat. And then we will see you next month.